a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about big tech ETFs that have a lot of exposure to technology giants. And we are talking about them because last week was the most important week of the earnings season. About 1/3 of S&P 500 companies reported last week, and all the technology giants reported last week, including Apple, Microsoft, Google parent Alphabet, Amazon, Facebook, and Tesla, and all the big tech companies that delivered record revenue growth and just crushed estimates. And that showed us the power of these companies, the rising power of these companies. Now, all these companies benefited a lot from pandemic-driven trends because pandemic changed the way we shop, the way we work, the way we learn, the way we interact. And so people bought more iPhones, computers, laptops, watched more YouTube videos, used Facebook more, Instagram more, shopped more on Amazon, and small businesses, they increased their digitization, which again benefited companies like Google and Facebook because they increased their web marketing and advertising. Now, some of these trends are going to continue because habits become permanent, and many companies have already announced remote work policies. So growth is definitely not slowing down. That said, and digital adoption too also is not slowing down. That said, it is possible that best growth days of technology, big tech, are already behind it. And also as the economy reopens, many investors will invest more in companies, the cyclical companies that benefit from economic rebound. That said, I believe that big tech stocks and ETFs should be a core part of anybody's portfolio because these companies are profit-making machines. They generate so much cash and they already have so much cash on their balance sheets. They are going to continue to be an important part of our lives and the market. And because of the quality of their earnings and the cash on their balance sheet, these are giant stable companies that also provide safety to a portfolio. Now, the combined market capitalization of big tech companies is now over $8 trillion, and that is up. That's about 25% of the S&P's total market value, and it is almost double from 5 years ago. So that shows the importance of these companies in major indexes and in our lives too. Now let's take a look at 3 very popular ETFs that provide a lot of exposure to big tech companies, but they are quite different from one another. So the first one I'm talking about is by Vanguard. It is the most popular technology ETF. Ticker symbol is VGT. It follows a market cap weighting methodology, one of the cheapest tech ETFs, 10 basis points in expense ratio, and as I mentioned, the largest with 45 billion in assets. Now, to learn more about this ETF, you can go to the quote page on Zacks.com, read our research report and articles, and you can go to the external homepage, Vanguard's web page for this ETF, look at the holdings and other details. Now you will see, if you look at the holdings, Apple is almost 20% of the portfolio, then Microsoft. Now you will not see Google and Facebook in this ETF because they moved to the communication services sector in 2018 as a part of GIGS alignment. You will see chip giants, NVIDIA, Intel, and you will also see fintech companies, Visa, MasterCard, PayPal in the ETF. Now, the second one I'm highlighting is by iShares. It is iShares US Technology ETF. Now, this follows a different index, technology companies in the Dow Jones US Total Market Index. So you will see the difference in the holdings when we go to the code page. This is also market cap weighted, but has some caps so that there is not too much exposure to the largest holdings. This is expensive compared to VGT, has 43 basis points expense ratio, and this is also very popular with 7.5 billion in assets, although not as popular as the earlier one. Again, to learn more, you can go to the code page and then iShares webpage. For the ETF, you can look at the portfolio. Now you will see Apple is the largest holding, 18%. Then Microsoft is 16%. You will see Facebook and Google, both classes of Google shares in this portfolio, because as I mentioned, this is a different index and this includes Google and Facebook in the technology sector. You will still not see Amazon and Tesla because both the indexes that we discussed, they classify Amazon and Tesla in the consumer indexes, consumer services and consumer discretionary indexes. You will see chip companies here, a lot of chip companies, and that is the exposure you will get in this ETF, AMD, Lam Research, all those companies. Now, the third one which I'm highlighting is by Invesco. It is Invesco Nasdaq 100 ETF, and the ticker symbol is QQQM. Now, it is just the lower cost version of the ultra popular Invesco QQQ ETF, which we have discussed in our videos in the past. So if you are a long-term investor, you should own QQQM because it is cheaper. If you are a trader, you should use QQQ because that has more liquidity. This also follows a modified market cap weighting methodology, has 15 basis points expense ratio versus QQQ's 20 basis points. And even though it launched in October last year, this has already become quite popular with 845 million in assets. Now, again, you can go to the code page and read our research report articles, and you can go to Invesco's webpage. Now, why I like QQQ and QQQM is because you get all big tech companies, what is the growthiest companies in the world, not only in the technology sector, but also in some other sectors in one ETF. So you will get Apple, Microsoft, Amazon, Tesla. Remember, Amazon and Tesla were not at the other two technology ETFs, and you will also get Google, Facebook, and then the chip companies like Nvidia and fintech companies like PayPal, everything in one ETF. Now, if you look at the comparative performance over the past year, now these companies and these ETFs had done very well over the past year, particularly last year. Now this year technology, as you know, hasn't done as well as some of the cyclical sector, but looking at the past year's performance, 1 year performance, you will see that all the three ETFs that we discussed, they are up between 60 and 65%, whereas the S&P 500 index is up about 50% over the past year. Thanks for watching, and in full disclosure, I own VGT in the ETF investor portfolio that I manage. Make sure to subscribe to our videos and also make sure to check out zacks.com/promo for an interesting offer, and I'll see you next week.